The bond market is in big trouble. We are seeing investors rapidly losing confidence in the ever-deteriorating US fiscal situation and economy overall, leading to interest rates on US Treasuries rising despite baseline interest rates starting to fall. The supply of US debt is increasing to keep up with this spending addiction, and yet the demand for US debt is not keeping pace, especially as we are now seeing a number of global central banks begin to sell out of their holdings of US debt. Less than 2 months ago in mid-September, the 10-year Treasury yield was sitting at around 3.6%, but has since surged to now being over 4.4% despite a brief post-election rebound. This is a big increase in the yield over a very short space of time, despite the Fed cutting interest rates by 75 basis points in this time period. And this chart from Apollo shows that for the first time in recent history, we are now seeing investors price in a premium on 10-year Treasuries, despite the market expecting 5 Fed cuts over the next 12 months, as well as oil prices falling. And this does suggest that concerns are growing around fiscal sustainability, making long-duration bonds less attractive to hold, driving up the rates. But it's not just the 10-year yield that has surged though, as we have seen noticeable increases in other bond durations as well. And we are now seeing an unprecedented disconnect take place between the price of gold and the price of US Treasuries, with the gap between the two assets getting wider and wider. Now this chart shows that the price of gold has historically correlated very closely with the inverted real yield on 10-year Treasuries, meaning that as gold prices rise, 10-year Treasury prices also rise. However, since 2022, we have seen a break in this correlation, and in 2024, we have seen the gap between the two assets only get bigger as the price of gold has surged at an astronomical pace, but the price of US Treasuries has been declining. Now, with all of the geopolitical tensions that we are seeing in the world, many investors have been flocking to gold as a safe haven asset, and we have also been seeing a number of major global central banks aggressively buying up gold to add to their stockpiles. In fact, 2022 and 2023 were the biggest ever years for central bank gold demand, and 2024 is on pace to set a new record once again, seeing the largest ever demand for gold in the first half of this year. This includes the Chinese central bank, who have been piling into gold for a number of years now, while at the same time dumping their holdings of US Treasuries. China has in fact only increased the pace of their sales of US Treasuries recently, and since 2014 have reduced their total US Treasury holdings from over $1.3 trillion to now being below $800 billion. A new report by Goldman Sachs expects high demand from central banks to continue, as central banks have seen the Western sanctions placed on Russia, treating this as a lesson to diversify reserves away from US dollars. And analysts did write, "We assume that central bank purchases will moderate to a monthly pace of 30 tons, which is about a third of the elevated 85 tons average monthly pace that was observed since 2022. But structurally higher than the 17 tons monthly average pace before the freezing of Russia's reserves." They also expect easing US interest rates to gradually boost Western ETF holdings backed by gold, as well as safe haven investors to keep piling into gold over geopolitical and inflationary tensions. And this Goldman Sachs model does estimate that every 100 tons of additional gold demand lifts the gold price by 2.4%. And as a result of this elevated demand coming from a number of places, they are projecting the price of gold to rise by 8% to $3,000 an ounce by the end of 2025. Now, with this current period of interest rate cuts causing market volatility, some industries and asset classes are declining while others are benefiting. For those looking to make the most of the current market volatility with their investing and trading, Moomoo is a great platform to give a try, and they are kindly sponsoring today's video. Moomoo's platform has a vast technical analysis toolkit of over 100 indicators, 45 drawing lines and 6 chart types for a more informed trading experience. They have a 24/7 news function that integrates more than 50 professional and quality news sources to give you the latest investment news and global market information, giving you the key information needed to make quick and informed decisions. Moomoo also offers 6 types of conditional orders, including stop loss and take profit, enabling you to capture potential profits and manage risks more effectively without the need to constantly monitor the market. Furthermore, Moomoo supports pre- and post-market trading, fractional share trading, and is also one of the lowest cost trading platforms with zero commission on stocks, options and ETFs, with no minimum deposit required and no account maintenance fees. Now is a great time to join Moomoo, as there are a number of great incentives that they are offering right now. If you are a new user, sign up using my link and make a qualified deposit to receive up to 15 free stocks, along with a 4.35% APY base rate, plus an additional 3.75% APY booster for 3 months, up to $20,000 on idle cash. So sign up to Moomoo today by using my link in the description and in the pinned comment. Now, one of the big reasons for bond prices plummeting and gold prices surging is the ever worsening fiscal situation the US is facing, which is leading to investors rapidly losing faith in US debt and also the US dollar. Now, in the fiscal year of 2024, the federal government ran a budget deficit of $1.8 trillion, which is an increase of $138 billion, or roughly 8%, higher than the previous year's deficit. This is a continuation of the ever-worsening budget deficit trend that we are seeing over time, where the gap between what the government is earning from tax revenue compared to what they are spending is getting bigger and bigger over time. Now, throughout the majority of history, the budget deficit would generally be well below 5% on average, with the occasional year being a budget surplus, allowing the government to support the economy during later times of need. For the past few years though, this budget deficit has been breaking this 5% barrier, and projections from the Congressional Budget Office forecast that this deficit is only going to continue to get worse, reaching a whopping 8.5% over the next 30 years. Now, these consistently large budget deficits are contributing towards the total government debt pile surging at a pace that we have never ever seen before, recently spiking to a whopping $35.75 trillion. Now, when we look at the spending category breakdown, we can see that there are multiple categories seeing increases year over year, but net interest payments are the largest increase by a significant margin. Now, government expenditure on interest payments continues to surge at an eye-watering level, despite interest rates now starting to come down, and recently hit a new, even higher all-time high of $1.12 trillion every year. The problem is that these payments get bigger and bigger as the total debt pile gets larger, unless interest rates on the debt come down as well. And as we've already discussed, this is not necessarily the case, despite baseline interest rates starting to come down. The market determines what interest rates they are willing to take on new government debt being issued, and if the supply of this new debt being put onto the market by the government through debt auctions is getting bigger, while the demand from willing buyers is not keeping up with this pace, then this is a problem. If there is an oversupply because of the demand not being there, then we are likely to see the rates on US Treasuries continue to trickle upwards, like they have been doing in recent years. The IMF is also now warning that now is the time to reduce debt burdens, calling for fiscal policies to prioritise debt sustainability and rebuild fiscal buffers now rather than later, as debt levels are higher than before the pandemic. They also particularly warn that the US debt as a percentage of GDP is far higher than the global average and is only projected to get higher and remain well above 100%. Now, one other big element that is leading to investors demanding a higher yield to hold US debt is fears growing around a second inflation wave hitting the economy in the future. Now, the yield investors get on their money being parked in US Treasuries needs to be higher than inflation over that same time period, otherwise they will be losing money in real terms. Inflation had been making good progress at coming back down towards the 2% Fed target. However, it has recently just jumped back up from 2.4% in September to 2.6% in October. And there are many economists who are getting increasingly worried that the Fed has made a big mistake by starting to cut rates too quickly and aggressively. This is because of a number of concerning forward-looking indicators that have historically led inflation that are beginning to flash red on a potential second wave of inflation hitting soon. Now the first of these is the annual rate of increase in the M2 money supply that has been surging since summer of 2023. Now this metric has historically been a loose leading indicator on where we can expect CPI to be 1 to 2 years in the future, and the correlation can be seen clearest in recent years, where there was a big spike in the M2 money supply growth that peaked in February of 2021, which then led to CPI peaking a year and a half later in June 2022. And another key indicator that leads CPI is the Global Supply Chain Pressure Index, which takes into account transportation costs and manufacturing data to get a gauge of how much stress global supply chains are under right now. There is a close correlation between this pressure index and CPI, with CPI usually lagging behind by roughly 6 months, and as we can see on this chart, the index has been trending upwards since May of 2023 due to growing geopolitical tensions amongst other things. Now this means that we could expect to see upwards pressure on CPI in the future, especially considering that there are no signs of these tensions reducing anytime soon. Now history does tell us that cutting interest rates too quickly after inflation starts to drop from an initial peak can lead to a second wave of surging inflation, just like in the 1970s when this inflation resurgence reached even higher highs. The path that we are now on is eerily similar to that of the 1970s, and with multiple indicators now signalling more upwards pressure on inflation and a potential second inflation wave, investors in US Treasuries are going to be very cautious about locking in yields that might end up underperforming CPI over the Treasury durations. Now, the stock market has been booming recently, especially post-election, where we have seen a big rally. But valuations are now at historically high levels, and we are starting to see a number of super investors and corporate insiders cashing out of their stocks and loading up in cash, leading to concerns around a potential market correction. Now, my previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, remember to check out Moomoo by clicking the link in the description, and also leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.